When markets melt down, most people see chaos. Screens go red, headlines scream crisis, and retail investors rush to sell whatever they can. But in the same 48 hours, a very small group of players quietly go shopping. Sovereign wealth funds, long-term institutions, and ultra-patient capital start moving billions into very specific assets, while everyone else is running for the exits. In this video, I'm going to walk you through that elite liquidity playbook. Not theory, not hype. A geostrategic map of what the big players actually buy when the world panics, and how you can translate that into your own long-term wealth-building system. If you want grounded financial education instead of noise, and you want to think like capital, not like a headline, subscribe now and turn on notifications. This channel is built for adults who are done guessing and ready to run a real system with their money. Let's step into the money game. When you're looking at the market through a retail lens, panic feels like the end of the story. But from a liquidity lens, panic is a temporary distortion in price, not in value. In every major crisis, one thing is consistent. Cash becomes emotional. Retail investors confuse volatility with risk, and they confuse price with narrative. Meanwhile, elite capital looks at one thing: forced sellers. Sovereign wealth funds, large pension funds, and long-term asset managers are trained to think in terms of decades, not days. They ask, who is being forced to sell quality assets to raise cash? Which asset classes are temporarily mispriced because everyone is deleveraging at the same time? This is why you see them step in during drawdowns to buy specific equities, prime real estate, infrastructure, and sometimes even entire companies. They are not brave. They are systematic. Their playbook is built long before the panic hits. Your edge as an individual is not speed or size, it's clarity. Once you start seeing panics as scheduled discounts in a long-term investing system, your entire emotional relationship with volatility changes. You move from please stop to show me where the forced sellers are. Elite capital doesn't ask, is the market up or down? It asks, where is liquidity tightening and where is it being created? Liquidity, simply put, is the ease with which you can turn assets into cash without moving the price too much. During panics, liquidity vanishes in some places and concentrates in others. Sovereign wealth funds watch this through three big lenses: credit markets, funding markets, and cross-currency flows. When credit spreads blow out, they know someone is paying a very high price to stay alive. When short-term funding becomes expensive, they know leveraged players will be forced to sell. When currencies move violently, they know which countries are becoming on sale for long-term investors with stronger funding bases. This isn't about prediction, it's about preparation. Their systems are built to say, if liquidity vanishes in X market and forced selling appears, we rotate Y% of our dry powder from safe assets into those distressed but fundamentally sound assets. As an individual investor focused on long-term wealth building, your goal is not to copy every move. Your goal is to learn how to read liquidity as a signal, not as a scarecrow. That's the mindset shift that separates quiet wealth from emotional trading. Think of the elite playbook as a stacked pyramid of liquidity and risk. At the base, high-quality short-term instruments, cash, T-bills, money market funds. This is their dry powder. Not because they're scared, but because they want optionality when everyone else has none. One level up, core defensive assets, investment-grade bonds, high-quality dividend stocks, broad market ETFs in regions they understand well. These are their steady compounders in normal times. Above that, strategic assets, infrastructure, prime real estate, high-quality companies temporarily mispriced. These are often bought more aggressively during panics, when valuations are compressed. At the top, opportunistic bets, distressed debt, turnaround situations, sometimes even private deals carved out of crisis. The key is that they don't guess with 100% of their capital. They run a system of buckets, each with a role in their long-term investing strategy. When volatility spikes, they don't ask, what do I feel? They ask, which bucket gets funded now based on our rules? That's the architecture you want to internalize. Not random moves, but a liquidity stack that tells your future self how to behave when everyone else is losing the plot. By the way, if you're enjoying the video so far and want more topics like this, comment the word "more" so I know. When the world panics, you can almost script the retail behavior. Step 1. Headlines turn red. Step 2. People check their portfolios more often. Step 3. Instead of reducing risk systematically, they sell whatever just dropped the most, usually high-quality assets, and hold on to the junk because it's already down so much. At the same moment, sovereign wealth funds and large institutions are doing the opposite. They're combing through their watch lists of world-class assets they refuse to overpay for during the boom. They're asking, has this business model actually changed or just the mood? If the answer is the mood, they start buying in pre-planned tranches. The tragedy is that retail investors often become liquidity providers at the worst possible time. They sell low to fund someone else's long-term return. Your job is to stop being the emergency exit for elite capital and start standing next to them instead. That doesn't mean blind optimism. It means building a clear framework for which assets you consider strategic and how you'll scale into them when valuations compress, not if, when. Let's get specific. In a classic global risk-off panic, where does elite capital typically look first? They start with core equity indexes in markets with strong institutions, rule of law, and deep capital markets. Think broad indices that hold the world's most profitable companies. When those trade at crisis-level multiples, long-term investors quietly accumulate. Next, they look at sector dislocations. Entire industries temporarily crushed by sentiment, but structurally necessary. Energy, transportation, critical technology, healthcare. They don't buy every company. They focus on those with strong balance sheets and durable cash flows. Then they scan real assets, prime real estate in world cities, infrastructure, logistics networks. Panic often creates forced sellers in these spaces, especially if leverage was high. On the fixed income side, they may move into high-quality credit that's been indiscriminately sold. Notice what's missing: lottery ticket speculation and highly fragile assets dependent on constant optimism. The elite playbook is boring. It's disciplined, data-backed financial education applied under stress. The question for you isn't what do they buy? It's which of these crisis assets can I reasonably analyze and how do I pre-commit to my own rules before the next storm? Elite capital doesn't wait for the news anchor to say, this is the bottom. Their systems are wired to pick up when probabilities shift. They look at volatility indices to see how extreme fear has become. They track credit spreads to measure real financial stress versus just equity drama. They watch margin statistics and fund flows. Are retail investors dumping stock funds at record levels? Are ETFs seeing historic outflows? They also track sovereign and central bank behavior. Is a central bank providing massive liquidity backstops? Is a government launching fiscal support? These actions don't magically fix everything, but they do change the range of outcomes. For your own long-term investing system, you don't need a Bloomberg terminal. You can follow a few simple metrics: valuation ratios for your watch list, the behavior of broad market indices relative to historical drawdowns, and basic sentiment indicators. The point is not to catch the exact bottom. It's to know when you've entered the probabilistically attractive zone and start scaling in calmly. This is where having a rule-based system separates you from emotional crowd behavior. When your decision is anchored to predefined triggers, panic becomes a signal, not a command. Let me show you this playbook in action with a simplified but realistic story. Two investors, Daniel and Marcus. Daniel is 45, a classic retail investor. Good income, scattered investing habits. In early 2020, he'd finally built a portfolio of index funds and a few quality companies. When the pandemic hit and markets fell fast, he watched his account drop 30% in weeks. Headlines talked about depression, unemployment, and unprecedented chaos. Daniel panicked. He sold almost everything, telling himself he'd get back in when things looked safer. Marcus is 52, runs capital for a long-term family office. He'd been underweight equities for months, building a cash buffer and a list of target assets. When the same sell-off hit, he didn't enjoy it, but his system triggered. If broad indexes fall beyond a preset band and fundamentals haven't structurally changed, start deploying cash in stages. Over the next 6 months, Daniel sat in cash waiting for reassurance. Markets recovered rapidly. By the time he felt safe, he'd missed a large part of the rebound. Marcus, following boring, pre-planned rules, locked in a decade of compounding at discounted prices. Same crisis, same headlines. 2 completely different outcomes, not because one was smarter, but because only one was running a liquidity system instead of an emotional reaction. You can't be a sovereign wealth fund, but you can absolutely build a personal version of this liquidity playbook. Start by defining your buckets. How much of your net worth sits in true emergency cash, how much in steady long-term investing vehicles, and how much are you willing to deploy more aggressively during panics? This is asset allocation through a crisis lens. Next, build a watch list of assets you believe in for 10, 20 years. Broad index funds, specific sectors, maybe a few individual companies you truly understand. Your criteria should be simple: durable business model, strong balance sheet, and a history of weathering storms. Then define your crisis triggers. For example, if this index falls 25-35% from recent highs and underlying earnings remain intact, I will invest X% of my reserved crisis capital in 3 equal tranches over 6 months. Finally, write it down. This is where financial education turns into a system. The point is to make the decision in a calm state, so that your future self only has to execute, not argue with fear. A real liquidity playbook doesn't sit in isolation. It has to plug into your actual money life: income, spending, investing, and net worth. Most people try to copy elite strategies, while their personal finances leak in 10 different places. High-interest debt, random subscriptions, inconsistent saving behavior. In that state, panics feel terrifying because there's no surplus capital to take advantage of them. Your first job is to stabilize your base system. Get clear on your monthly cash flow, automate a baseline level of investing, and intentionally build a crisis cash buffer that exists for opportunity, not just emergencies. And to make this journey effortless, we're building the Trip to Wealth Command Center, a Google Sheet system that brings your income, spending, investing, and net worth together in one place. It's your personal strategy hub, designed to expose money leaks, highlight growth opportunities, and show how small decisions compound into real wealth. Join the early access list below and secure a discount as an early supporter. Every wealth system needs a strategy. This is where yours begins. Once your base is stable, the elite playbook stops being an abstract idea and starts becoming the natural extension of a well-run life. There's a dangerous myth that elites are fearless risk-takers. In reality, the institutions that survive across cycles are paranoid about risk management. When they buy during panics, they are ruthless about position sizing. They assume they can be early. They expect further drawdowns. That's why they scale in over time instead of going all in at the first sign of cheap prices. They diversify across assets, regions, and time. A sovereign wealth fund might be deploying into U.S. equities, European infrastructure, and emerging market credit simultaneously, but in carefully measured doses. For you, that translates to 3 rules. First, never use money you emotionally cannot see fluctuate. Second, never concentrate your crisis bets into a single fragile asset. Third, give your positions real time to work. Years, not weeks. Long-term wealth building is not about avoiding volatility. It's about surviving it and harvesting the return it offers to those who stay in the game. Systems, not heroics, keep you in that game. The biggest difference between elite capital and retail investors is not access to secret data. It's emotional training. Institutional investors are used to seeing large numbers move daily. They're evaluated over cycles, not days. They have investment committees, written policies, and checklists that slow down impulsive decisions. Their identity is connected to process, not just performance. You, as an individual investor, can start borrowing that psychology. First, reduce your news diet during high volatility. Focus on data, not drama. Second, revisit your written plan. Ask yourself, has my thesis changed or just my mood? Third, remember the time horizon you originally committed to. If you bought an asset for a 10-year compounding, a 6-month drawdown is noise, not a verdict. This is genuine financial education, understanding that your nervous system will always want to escape discomfort and designing a system that keeps you aligned with your long-term investing strategy anyway. The more you practice this, the more a crisis feels like a scheduled test, not a personal attack. The reason the Elite Liquidity Playbook matters is simple. Most of the long-term outperformance comes from a small number of well-timed, well-structured decisions made during periods of fear. Buying quality assets at compressed valuations accelerates compounding. It shortens the time it takes for your capital to double, not because you're chasing high-risk bets, but because your entry price is rational. If you can combine 3 elements, steady investing during normal times, disciplined accumulation during panics, and a refusal to panic sell quality, you create a personal compounding machine that mimics the behavior of much larger funds. Quiet wealth is not about never feeling fear. It's about pre-training your response so that when liquidity dries up for everyone else, you become one of the few willing and able to provide it, at a price that heavily favors your future self. In that sense, every crisis is a character test disguised as a market event. Let's fast forward. At some point in the next decade, we'll see another major panic. The headlines will look different, the script will be the same. Before that happens, you can make a choice. You can remain in the default setting, reacting to each crash as if it's the first time in history markets have fallen. Or you can step into the role of a strategic thinker who operates with clarity and a solid, process-driven foundation. Write down your liquidity buckets. Clarify your watch list of long-term assets. Define your crisis triggers. Decide in advance how you'll deploy, how much, and over what time frame. You're not trying to beat sovereign wealth funds at their own game. You're trying to borrow their discipline and compress it into a version that works for a single human life with finite income and finite time. When the next storm hits, your past self will have left you a map. All you'll have to do is follow it. We've covered a lot, so let's bring it together. Panics are not just crashes. They're temporary liquidity distortions that force weak hands to sell strong assets. Elite Capital uses a clear liquidity stack, from cash to strategic assets, plus simple signals to decide when to buy. They pre-commit to rules, scale in patiently, and let compounding work across full cycles. You can mirror this by stabilizing your personal finances, defining buckets, creating a long-term watch list, and writing down crisis triggers before fear shows up. Start small. Build your emergency buffer, automate basic investing, then prepare a modest crisis capital plan. Consistency matters more than size. The goal isn't perfection. It's to be slightly more prepared than the crowd every single time. Remember, this video is for educational purposes only and does not constitute investment advice. The value of investments can fluctuate, and past performance is not indicative of future results. Always assess your risk tolerance and investment goals before allocating your capital. And there you have it, the Elite Liquidity Playbook. If you found value today, I highly recommend watching my next video. Don't forget to like, share, and subscribe to our channel. Also, feel free to leave your comment below, especially if this video made you think differently. I appreciate your support more than you know. Until next time, stay consistent, stay patient, and stay winning. See you in the next one, Money Magician.